Hello, everyone. I'm Tudor Franco. I'm here with my friend and partner, Saket Jain from Migrate to Wealth. And we want to do a little short webinar for information and educational purpose to kind of go over a few questions that a passive investor would have to vet and know a GP team on a multifamily deal. So we're gonna, have a little conversation of what we think the main questions would be and the correct answers would be. So welcome, and let's go ahead. How are you,
Hey,
Saket?
Tudor. Hey, listeners. Thank you for tuning in. Appreciate it. Feel excited, man. Excited to be. This is becoming a series. That's amazing. I love it.
Yes, absolutely. I hope the listeners can enjoy and learn from it.
Awesome, man. Awesome. Let's do it.
So, Saket, let's say I'm a passive investor in your deal.
Yeah.
And you are one of the general partners, and I'm one of the passive investors in your deal. We're going to try to see what should I ask you to see if the deal is appropriate for my investment or not. So I think one of the first questions I would ask a general partnership team is, what is your track record on your past deals? Like, what have you done? Can you show me some financials? Can you show me some performance? What would you answer to this?
So I think it's an interesting question, right? Because if you think about it, given the time today, it's an interesting time because what we're sitting on is last 5 years, theoretically, if a monkey touched a deal, that the deal would have turned into gold, right? So I think there's some discussion around what's the tenure of the syndication team. So collective syndication team, right? So now if they've only started 2 years ago and the collective team, and that's the only experience they have, you want to dig deeper. Now, there's nothing wrong because in every business, there's going to be a newcomer, right? So that does not mean and I'm from Airbnb. So when Airbnb was launched, it was new. But look at what's there now. So it doesn't mean new doesn't mean wrong. All new means is you have to dig it even deeper. So if they have less than 5 years of experience right now, or maybe less than 7 or 8 years of experience, that essentially means that they have not seen business cycles, right? So you want to dig deeper into those track records, their financials. The question is right. What's your track record? The level of due diligence you do depends upon what answer you get from them. If they're basically coming up and saying in the last 5 years, we have sold X number of deals and everything has 30% IRR, and then in some of the deals, we have 4X'd. It's a good data point, but that's not where you should end, right? You got to get deeper into what about those deals and what happened, how many of deals went wrong. So the track record is a starting question. And then depending upon the answer, you change your approach to go deeper into that.
Okay, so you would suggest having a deeper conversation with those general partners,
of course,
regarding either their track record as an individual or as a team, or however they did the deals in the past.
And also, it doesn't. So multifamily is a business, right? It's not really a single family where you can buy a single family off of MLS and then continue to run it through a property management. It's really a business. So let's just say a newcomer comes in. So I'll take my example, right? So my example, I'm a management consultant. So I used to fix businesses, and then we would buy businesses which were broken for our clients. We would fix them up, and then we would sell them, right? So when we look at that example, and if I were to launch it today, multifamily business, would you consider me as a risky track record? Yes and no. If I'm doing it by myself, although I have the chops in the business world because I've been part of the business turnarounds, so that makes me check a few boxes, but I still am lacking on the multifamily area. So let's say now I partner with you who have a 10 year of experience, 15 years, 20 years, depending upon who the partner is. Now they bring the multifamily experience. I build along with the other skill sets, and I bring in the business acumen. And together, when we marry the two experiences, it's a powerhouse, right? That's really what you're looking for. You're looking for their relevant experience of how. Now, that does not mean if somebody wasn't a management consultant or a business operator, they're again not going to be good. There's no thumb rule, right? These are subjective decisions that you as an investor will have to make. But if you don't ask the question, you won't get the answer.
Correct. What would be another question you're thinking about asking as a passive
I think one
investor?
of the questions that you really, really, really want to ask, given the time right now, is tell me a deal that did not pan out the way you planned to. Now,
Yeah,
there's two ways the sponsor is going to answer that question. One
yeah,
is all of our deals have exceeded projections.
right.
You probably want to run away from that sponsor if that's the answer you get. I think the answer you want to hear from them is every project, every deal, every opportunity will have some mistakes, right? That
Absolutely.
you went in making an assumption of X, and when you executed on that, either things were in your control or out of your control, they didn't go. The X didn't happen, something else happened. It could be
Correct.
positive or negative. So they need to paint a story for you. And some mistakes are forgiving. You may want to be okay with that. Someone may not, some may not, right? If the delta between the projection and the variance is over 20, 30, 40%, you mean that basically they didn't know what they were doing, right? Now, most cases, now if the debt comes into the picture, current market situation, if they had projected the interest rate at 3% and now the interest rates are 8%, you have to ask the question, when was the underwriting done? If it was underwriting done was maybe a year ago, that's probably a miss from sponsors, right? But if it was done 2 or 3 years ago, no one expected the interest rates to go to 8%, 9%.
Well, yeah, that's another thing also, because in the past few years, the market was basically going so well for everybody that you
Yeah,
wouldn't have to do much to get the deal going right.
correct.
So the track performance of those past few years on a GP team were mostly, done well.
Correct.
But that doesn't mean that their performance as a asset management team is spectacular.
Exactly.
Um,
Exactly.
and you're right. I mean, deals are not going well sometimes, and you have to know what the GP team did as a solution to their
Mm-hmm.
challenges. And that would be, for me as a passive investor, that would be something that I'm looking for to see, not if they had challenges, is how do
Yeah,
they approach challenges.
exactly. Exactly.
Yeah,
And did they hide the bad news? Right. A
right,
lot of
right.
sponsors, the knee-jerk reaction for a lot of people who are new in this
Yes,
business is that let me just not tell this to the investor.
yes,
And eventually things will get fixed. Bad news does not get better with time. Bad news
correct.
gets worse with time. The
Yes.
sooner you
And
deal with it, the better it is.
you will see, from my experience, I've seen a ton of newsletters about deals, right, that are coming
Yeah,
monthly or quarterly or whatever. And everything looks so peachy in those newsletters that you wonder why are not like getting so many
yeah,
distributions if everything is going right.
correct,
So the way you communicate with those passive investors is very important, and just keep transparency going. Even if you have a challenge or
correct,
extra expenses or occupancy is going down or whatever it is, nobody expects everything to be perfect, but
correct.
everybody expects to be communicated well.
Of course. No, that makes sense.
Yeah, yeah,
So
absolutely.
Tudor, what do you I think those two are very important, right? What is something that you have an absolute must beyond those two from your perspective? Because you're also a limited partner in
Yes.
multiple, you and I both invest in other people's deals because you have to.
Yeah.
You should because you can't be everywhere. So you have to diversify your own portfolio as well. What is one or two things that you look for beyond the two that we just talked about?
Yeah, absolutely. I think for me, two things that are very important when I look at a deal is, where is the deal located?
Yeah.
Where is the property located? Like if it's located in an area that has a lot of growth and jobs in the past, 5 years or so. If people are moving in, if jobs are created, there's a lot of commercial activity going around that area. So, we'll make sure we keep that growth going.
Yeah.
That would be one thing that I'm looking for, a great location of the property. Because in real estate, as it's a saying, it's location, location,
Location,
location.
location.
That's
Yeah.
all valid in the commercial space also.
Right. Right.
The second thing I'm looking at, number two, very important, is who is doing the asset management for that property from that team. Because it's not enough to purchase a good deal and get the right amount of tenants or growth or location. It's also important how you maintain and perform with the deal from the point that you purchased on. So the asset management would be very important for me to make
Why
sure.
is that? Why is that important, Peter?
It's important because you're gonna have challenges, like we said, and the person who's making the decisions on how the asset performs, it's a very important person. Like you need to make sure that person has a track record that solve the problem, business experience, solving problems and challenges that can occur overnight, basically in a property, like storms, natural disasters. You can face any kind of issues on the face of the earth that you can experience on a commercial property, and you need to make sure that person deals with those things right away. Some teams have one general partner in the team that is the asset manager, and is located in that general vicinity of the property. Or some teams have hired a full-time property manager that is on site all the time and it works there basically, and oversees the general running of the property. So either option would be okay for me, but I want to make sure there's somebody assigned to take care of that issue.
Tudor, you mentioned property manager. I don't think they're hiring I think you're talking about an asset management manager, not the property manager, correct?
Correct. Yeah, I was talking about hiring an asset manager on site that can supervise the property manager that you're hiring for the.
So let's go deeper. So let's say I have a deal in Houston. I live in Raleigh. You live in DC, DC Metro, right? So both of us partner and acquire a deal. How do we convince our investors at that point that the person that we hired in Houston as an asset manager, because one of the big reasons to hire an asset manager there is because every time we would go travel to asset manage the deal, that's going to become an expense to the property, right? As a travel expense. We want to minimize that as well.
Correct.
So in that specific scenario, how would you convince your limited partners that, this is deal still digging. They may still need to make decision, but that can't be the decision to walk away from. They have to dig deeper into that. So how would you approach that?
So if a passive investor would ask me that question, I think the first answer I would give is, I want to have someone who's on the site 24 hours a day. And I can, as a general partner, even if I'm the asset manager in that partnership or not, I can call 24 hours a day and say, hey, so-and-so, what is actually going on in the property? What is the challenge? Because he's our employee. It's not the property management employee. So you need to have someone there to supervise what your property management does. And you trust, but you verify. Right? So I think that's the most important thing that I would say to a passive investor who has questions about this, because yes, the expense is there. And I honestly think it's well worth it to hire a full-time asset manager on site. If none of the general partners are living in strict vicinity of the property. But we, like in your example, right? We're both away in other states and we purchase a property in Houston, for example. We have two choices, right? Either we partner with someone who's local and we design that person to go there and supervise everything, or we hire an asset manager on site that either lives next to the property or lives on the property in one of the units. And it's the best, like super, so-called in a building, right?
No, I think that actually makes sense, Tudor. What I was thinking about was most syndicators you'll see, everyone's trying to differentiate themselves, right? So as a listener, you want to make sure that you're taking everything that even we say with a grain of salt, because you have to make sure that you're collating different perspectives and making your own decision matrix, making your own investment philosophy, right? So a lot of the syndicators are now pushing into local syndicators. Let's say somebody was syndicating a deal in Houston. They would say, I'm local. Don't listen to these people who are remote, right? There is no black or white when you're looking at an investment.
Correct.
Every investment has to be looked in its totality. That's why somebody was asking me the other day, tutor, that, hey, can you tell me a thumb rule of these are the 12 thumb rules that you want to look for investments? I'm like, there's really no thumb rule. I can give you guiding principles,
Yeah.
but those guiding principles don't have a number that I can't say, look at the cash flow for less than 10%.
Right.
That's not a rule, because in some markets it could be, and some business cycles, the answer could be very different. So if I give you a thumb rule, you're going to be boxed into the thumb rule without a lot of context around it, right? So you have to develop that context. That's why you want to have conversations with more syndicators. And when the deal is live, that's not the time to evaluate a sponsor.
Right.
If you have to, you have to, right? There's no other approach.
Yeah.
There's no alternative, but hopefully you've done your due diligence. It could be months, it could be weeks, it could be days, whatever you feel comfortable with. You've asked these questions from sponsors so that when the deal comes to your table, when an opportunity is offered to you to invest alongside with a syndicator, you're focusing on just the opportunity and not everything around it, right?
I agree.
Most of us have now partners or our own syndicators that we are limited partners in. Like some of my folks that I invest with, I actually don't even look at their deal, because I know their underwriting, I know how strict they are, I know their performance. I'm like, okay, how much money what's the minimum? How much do I need to invest? And here it is. It's a decision becomes easier as you go with it. But your first few deals, you may have to go deeper to make sure you understand them.
Absolutely. Another question that I would ask is, as a passive investor, would be, do you have any concerns about the property management company that you're dealing with? Like, do you have any record with them? Do you know what they did? Do you know what properties are managing? What's their history? What the relationship is with you? How would you determine, as a general partner, how would you determine which property management would you hire for that deal?
I think it's so if you think about it, the last question that you talked about, right? The asset manager. The asset management is a very important role, and the heart and soul of the asset management is your property manager. So if you end up picking the wrong property manager, and Tudor, you and I invested in a deal together where the property manager didn't do what they were supposed to do. No fault to asset management team, but it didn't work out, right? So even if you pick the right one for that specific property, it didn't work out. But regardless, when we looked at that deal, I was looking for, okay, for the sponsor. I think before we go there, I think one of the things you want to ask is, how deep is the relationship between, how long have they known each other, these sponsors, right? That's an important one. And that just triggered, but I didn't want to lose my thought. But to talk about property management team is, what is the relationship that exists between the existing property management team and the team and the sponsorship side, right? So at least one person should have a deeper relationship with them. You would hope that if they have a track record, if they're starting new, that's a very different question, right? Because they won't have a long-term relationship with their property management company. But if somebody has 5-10 years of experience in the specific market, and they keep hopping from a property management to property management, so let's say hypothetically you have 5 deals in Houston, and for all those 5 deals, you use 5 different property management companies. There's something wrong.
Yeah.
Right. There's really something wrong, because in a specific market, unless you're buying deals, now again, nothing is black and white. When I say wrong, it doesn't mean you walk away from the deal. That's when you start asking more questions, because what could have happened is one deal could be class A, one deal could be class D, right? So the property managers who manage class A don't manage class D.
Exactly.
So that's a fair reason to have multiple property management companies. But if they're all class B, C, and they have more than 2 property management companies to manage 5 properties, you got to dig deeper. What is wrong? Are they not able to make decisions, or the property management is firing the sponsorship team so much that they keep switching from one to another? Right? Those are some of the things you want to look at. Also, you want to look at is, have they hired the right property management company? As we were talking about, you don't want to have a property management company that manages a portfolio of 100 single family homes to manage your Class B apartment of 100 units.
Correct.
Just because the quantity is same does not mean the effort is same. Right? It's a very different way of looking at that deal.
Yeah,
so you want to
I
make
agree.
sure that you're picking the right. So you got deeper into not just saying the relationship matters, but you want to ask questions about the property management company itself. And what you're also going to start seeing is a lot of the people are bringing the property management in-house now.
Right.
Now that is good and bad. Again, there's no right or wrong answer in this world. It's good and bad, because if the asset managers are good and they know what to do, having a captive property management team is actually good. Like the asset tutor you and I are part of, the investment that we're both limited partners in, if the property management was actually in-house, a lot of the problems would go away, because the asset manager there is amazing, right? We both know them. So it's not a problem with the asset management, but the property management team had an issue. Now, when you change the property management team in between, it becomes a problem because of the transition time, right? So having sometimes the in-house property management team or captive property management team could be beneficial. But also you need to understand the expenses of that, because if it's a captive property management team, that essentially means it's vertically integrated. So that means the sponsors are also getting the property management fee on top of the asset management fee, right?
Right.
It has to be fair and reasonable. If the market rate for a property management is 5% and they're charging you 10%, there's, again, a question to be asked. Again,
Yes.
nothing is a thumb rule, does not mean no. You have to ask
Yes.
a question. Why are they charging extra? You have to give the opportunity to sponsors to be able to explain it to you.
Yeah,
And if you're
absolutely. And
satisfied with the answer, great.
I think the choice of having, who's doing your property management on the deal is very important on how your occupancy is going to go in that deal, because there's so many things that you need to be careful with a property management. They're not only doing financials and going to post signs on the doors. They're also advertising the deal, online and on social media. Right. They have to like clean up the property. They make it nice, with nice signage and promotional materials and all this stuff. I mean, there's so many things that they have to do in order for the property to go well, that you need to keep an eye on everything they do. One of the examples that I have, I had a deal where we had a property management for like a few years, 3 years already, and something was slipping slowly. And at some point, the asset management came back to the investor and say, "Hey, I think we reached the point that we need to change the property management company because things are not going the way you're supposed to do." Right. And we've been working with them for so many years, but they're not the same. So this is an important thing for a passive investor to know, that things are not concrete in place. Right. They can change year by year, and the most important thing is how you make the property to go better and better.
Completely, man. Yeah, I think you said it right. I can't add anything to that.
Yeah. So I think, there's so many other questions that a passive investor should know before they get into a deal. I want to go to maybe one or two more quick questions.
Yeah.
One of them would be, for example, you're invited into a deal to invest, and you don't know much about the general partners or the sponsorship team, but you like the location, you like the profits or the advertised profits of the deal, and you want to invest your money, but you have an IRA. Mm-hmm. Is there what would be something that a passive investor would need to know how to invest with their retirement funds? Because this is one question that comes up over and over again. People have a lot of money in the retirement plans, but they don't know how to use it other than put it in the stock market.
Yeah, definitely. So I think for a longer answer, I actually have an episode on my podcast. I can't remember the episode number. It's one of the first 10 or 15 ones. So I would invite the listeners to go to Migrate to Wealth podcast. You can have a probably very detailed answer. But a short answer is really going to be investing with an IRA or non-IRA. It's a secondary question, right? First decision you have to make is whether you want to invest or not. But the second decision is, okay, where the capital is going to come from. Let's say if you want to invest $50,000 and you have some money available in your IRA. Now, in your 401k, let's talk about 401k for now. Now, you have something called as a self-directed IRA. You have to figure out, can you roll over your 401k, or let's even expand your traditional IRA? Are you able to roll that money into a self-directed IRA? Now, these self-directed IRAs are not the same as you can pick your own stock, right? You know how if you work for an employer, they'll say, here's a set of 5 mutual funds that you can invest in. You can't invest in stock and all. And then there's a flavor of that specific type where you still stay within the realm of stock market, but you are now able to pick your own stocks. You are now able to pick your index funds and all that good stuff. Well, we're talking about the self-directed IRAs in its true form, that you can invest in assets. There's some assets that are prohibited. You can't invest in alcoholic businesses. You can't invest in marijuana. You can't invest in gambling. Like, those are some major ones. But on a broad stroke, 95% of the asset classes you can invest in you can invest in crypto, real estate, gold, silver, precious metals, other precious metals, and stuff like that. So you can do that. So you can do that with a specific self-directed IRA. And there are custodians that are available, that third parties are available, right? So now let's say that all the thing is, now you have a self-directed. If you don't have a self-directed IRA set up, and you don't want to set it up, you can't invest through IRA, period, right? So the minimum requirement is the capital that you want to invest should be available in a vehicle, which would be a self-directed IRA that you're managed, that a third party manages for you. Now, there are several other alternatives. You can do a solo 401k, you can do an QRP plan, but there are other alternatives. But we'll keep it simple for now, self-directed IRA. So when you're investing, now you have a capital available in self-directed IRA, and you've made a decision, I'm going to invest in Tudor and Sackett's deal. Now, the next step is going to be to ask Tudor and Sackett, can you invest through an IRA? Because some syndications don't allow it. So now our answer is going to be yes, because all of our syndications deals, they allow self-directed IRA. So now you're going to say, is that okay? What are the protocols? So now you're going to talk to your custodian for the self-directed IRA to say, hey, well, I want to invest in Tudor and Sackett's deal. Here's the paperwork, and we'll provide you all the paperwork, the PPM, the offering memorandum, the articles of organization, and whatever is required by your custodian. We'll provide you that information. You'll take that information, give it to your custodian. Your custodian is going to review it. It usually takes a few days. And if everything checks out, if they have questions, you'll pass it on to us. We're more than happy to get on a call with them. So far, I've never had to get on a call with anybody. But if the custodian has a question, we will get on the call. Right? Yeah,
it's pretty much a streamline once the paperwork starts rolling.
Correct. And they know it, right? This is not new for them. They do this for a living.
Yeah.
So the custodians know these deals. They understand syndications. They know what to look for.
Yeah.
And then once you have that, everything checks out, they sign a form on your behalf. Be careful in understanding that do you sign the paperwork, or they sign the paperwork? They as in custodian. 99% chances are the custodian will sign the paperwork.
Yeah.
They'll sign the paperwork, they'll give it to you, or they'll give it to us directly. Once everything is done, we're saying wire the funds. Once you receive the funds, you're done. Right?
Yeah.
Now you have invested in this deal through your IRA. You will still receive a K1, right? Some of the IRAs investing needs the fair market value at the end of the year. We'll give you that analysis as well. We'll continue to work with your custodian to make sure whatever they need for tax filing and everything else, we're giving it to you. Right. But it's pretty streamlined as you think about it. It's money coming from your bank account versus money coming from my IRA. The steps involved are different. If the money is coming from your bank account, you can wire the money, but you have the full discretion of doing it. Now, when you're talking about the IRA, you still have the decision-making power, but your custodian has to be on board with it. And then they will make sure they finish the paperwork. So there's a few extra steps you have to take, but those extra steps are just extra steps. They're not inhibitors.
Yeah.
They're not doing the due diligence on your behalf. They're asking you to do the due diligence, right?
Yes.
So just because you're coming from IRA and you have a custodian does not mean they're your advisors, right? So you need to make sure you properly do your due diligence and then get your custodian involved.
Yeah. That's great. I want to be short and respectful of the time of our listeners and keep this short.
Yeah.
One more quick question and a quick answer. Passive investor asks, why do general partners have so many fees that are taken from the deal?
Yeah, it's perfect. I
Asset
think
management fee, acquisition fee, disposition fee, and all these fees. What are those means, and why do they have them?
I think it's the question that it's a great question. I love that question, but I think they should ask Tim Cook, why is he getting millions of dollars salary, right? It's really the same question if you think about it, right? Because when you invest in a stock of an Apple, you're asking someone like a in this case Tim Cook, you're asking Tim Cook and his management team to be the good stewards of your money. That's what you're expecting them to do.
Correct.
Now, their salary is a compensation for them to do good work, but the interests are aligned. I mean, stock market may be misaligned. So we'll keep that quite. After that, I won't talk about this analogy, but let's talk about syndication. So when we talk about syndication, right? So when you and I go find a deal, the deal is not appearing from thin air, right? We have to go travel. I mean, the amount of time and money that we spend on conferences and building these relationships. In the last 2 years, I was just looking at the numbers. I've invested close to $200,000 this year investing in this business.
Correct.
Now, I am not running a charity. You're not running a charity. Nobody else in this business is running a charity.
Plus the countless hours of underwriting 100 deals.
Correct. To
make
find
10
one.
offers and maybe get one.
Maybe get one, right? And then the thing is, now you're also risking your money. So the hard money is not just like a single family.
Correct.
In single family, depending on which market you have, your earnest money could be returned. Yeah. In our case, in multifamily, that earnest becomes money hard, which essentially means after a certain time, if you default on that deal, money is gone. And Tudor, you and I have had scars on that, right?
Yes.
We still cry over whiskey on that loss, which is fine. But those losses are there, so we're putting a lot at risk. On top of it, we're also signing on loans.
Correct.
So
it's a risk.
It's a risk to us. So anytime there is a risk and there's a time and resource commitment, the other party want to be compensated for. Now that does not mean that these fees are unfair. They cannot be unfair. They cannot charge you 10% acquisition fee unless they can demonstrate that it's worth. This is why they're charging it. Right?
Correct.
So the acquisition fees range between 2 to 5%.
Yeah, that's what I was asking. What would be the range, the normal range or acceptable range?
I think we talked about it during the last episode as well. So it's really, and we probably go back to that and listen to it more. But it's really somewhere between 2 and 5% acquisition fee. Yeah. The asset management fee is somewhere between 1.5 to 3%. And then the disposition fee is usually 1 to 2%. Right? These fees are reasonable. They're not, they are well worth it because you want to have your syndicator paid, because if they're not getting paid, they're going to move on to the next deal that's paying them. Right? Correct. You want them to also be involved.
Yes, that's great. Thank you so much, Saket. And I think we went over to a few questions here, and I hope the listeners are going to learn a lot from this, and hopefully we can do this again.
Yeah, we will. Not hopefully, we are doing it. Well, thank you again for tuning in, everyone.
Thank you. Bye-bye.